Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value and entertainment out of these videos, all I ask you to thumbs up and subscribe. Questions, comments, put those below. I want to touch on this week's video by sort of framing it up as we always do. But this time I want to do it with some comments from Madame Lagarde at the ECB, the European Central Bank, one of the largest, most influential central banks in the world. She was out with some policy comments this past week, and I quote, "Negative interest rates have often been criticized because of their potential side effects. Our assessment continues to be positive as the benefits continue to outweigh the costs." So that's from the ECB's Madame Lagarde. But I want you to think on that and dwell on that just for a moment because I was scrolling through my Twitter feed and I come across this account and I see it quite often and I emphasize with it, but it's one of those housing activist accounts and you're out there and they're slamming on Adam Vaughan, who is essentially the MP for the Canadian housing. Basically, he's responsible for a lot of it, and basically dunking on him, saying, "Hey, home prices are going up," and basically Adam Vaughan responded, "Listen, we're not going to, destroy the value of the equity in people's real estates just to appease the renter base. Like, we need to essentially try to manage this so we can kind of peacefully coexist." And again, everybody, you read the comments and everyone's going through it and dunking on this guy and saying, "Hey, it's your fault, it's your fault." And don't get me wrong, I think the guy is kind of useless. He hasn't been very good at his job, at least when you look at the numbers. But what I was trying to sort of emphasize to everybody is, whoa, hold on a minute here. We need to understand exactly what's going on. This problem that is emanating across the nation is not one MP's doing. This is part of the global monetary system. So let me kind of frame this up for you, because we just had Madame Lagarde that came out and said, hold on, we got negative interest rates. These are a good thing. These need to continue. What we have here today is the interworkings of a monetary system that is failing. You have to let's make this abundantly clear. This is a monetary system that is quite literally eating itself and is basically towards the latter stages of failing. It is a failing monetary system. And now, why do I say that? Because as Ray Dalio says, you have monetary policy 1, monetary policy 2, and monetary policy 3. And right now we're at monetary policy 3. So let's unwind this. Monetary policy 1, the traditional monetary policy that everybody's familiar with, your grandparents are probably familiar with, is that when the economy slumps, the central banks slash interest rates. And that usually helps you get out of that recession, right? You lowered borrowing costs for everybody. It allowed them to basically put some extra money in their pocket, go out, use that for consumption. So that's monetary policy 1. Okay, well, we can clearly see today, well, guess what? There's nowhere for us to cut interest rates. We're already at zero around the world. There's nowhere to cut. So that's monetary policy 1 is done. It's failed. It failed back in 2008. And so what was the answer? We went to monetary policy 2. Monetary policy 2 was basically quantitative easing, right? So what happened was the central banks essentially decided to, not only did they lower interest rates to the zero bound, but they also engaged in quantitative easing, which is essentially buying up loads of the debt market, government bonds, for example, and artificially lowering the yields on that, which essentially lowers the cost of borrowing for not only governments but corporations, households, and artificially suppresses them, and essentially creates excess bank reserves. We know all about quantitative easing. So that's monetary policy 2. Now we're in monetary policy 3, which is basically number 1 and number 2 aren't really overly effective anymore. You now have monetary policy 3, which is governments are coming in and basically doing, through fiscal spending, are essentially doing the central bank's job. And you've heard numerous times about the central banks coming out and saying, hey, we need more fiscal support, we need more fiscal support. Well, now we have it, right? COVID was the accelerator for that, where government stepped in and said, okay, we're just going to start basically running massive deficits. We're going to be doing essentially versions of helicopter money and all the likes, right? Let's give essentially government-supported loans to corporations, to households, to basically anyone that needs it. We're going to get through this. And that is monetary policy 3. So that's basically where the federal government basically does fiscal policy. They do their own version of monetary policy. So the stimulus comes through the federal government, but it is ultimately financed by the central bank. And that's obviously what we see here in Canada, right? $3 billion per week of QE, which basically coincides with the Canadian government's deficit spending. So this is monetary policy 3. And this is really like the end of the line. Now, getting the timing around the end of the line, I mean, this could be a year. It could go on another 10 years. But you're basically towards the sort of getting closer to the end of this failing monetary system. So what happens in this system? This is very, very reminiscent. I would encourage you to go read about the Mississippi bubble. This is very, very similar, where they kind of went through these same versions, which basically you have a situation where let's unpack house prices in Canada, right? So you have a situation where house prices continue to go up. I mean, there's not really a whole lot of economic fundamentals behind it. You look at stocks, you can look at the PE ratios that these things are trading at. You can look at all the shenanigans that's happening in the bond market. Negative yielding, junk debt, whatever. Anyways, you've got all these distortions in asset markets, right? And so everywhere you look, you go, oh my God, there's not really a cheap asset out there. Everything is just the valuations are just sky high. And what happens is, similar to the Mississippi bubble, is basically they ran into this situation where they kind of tried policy 1, policy 2, and policy 3, where basically all the asset holders got extremely rich. The banks were basically issuing loans on collateral. It wasn't necessarily always about how creditworthy the borrower was or income streamed. It was about the collateralization. So basically what happens here, think about a modern day scenario today, right? Banks look at it and say, hey, you've got an asset. We'll loan you money based off the value of that asset. And then by creating new money or by loaning more credit against that asset, you actually end up pushing the asset value even higher, which then creates even more collateral to keep lending. So we're in a system today where you're in an asset-based collateralization system. Lending is based on the collateralization of that asset. So for example, you can imagine what would happen here in Canada if house prices, let's say, fall 20% nationally. What would happen to bank lending? What reality is bank lending would collapse. You'd have a situation where people would no longer be able to tap, say, home equity lines of credit because, again, your home equity is falling down. That then reduces, say, the ability to use. You hear of stories where people use home equity lines of credit to, they draw that home equity line of credit and they use that as the down payment on another asset, right? So asset-based collateral lending. And so that's kind of where you're at today. You have the situation where people that own assets are able to leverage the value or the equity that has been created in that asset to then lever that up to get more assets. And so you are in this asset-based system. And so you have all these unfortunate people that are looking at it through the lens of, hey, I was told if I worked hard and I saved my money that I would be able to own a home and have a family. And I don't understand why home prices are going up 20% a year. And they're looking around and they're looking for someone to blame. So they're pointing the finger at the foreign buyer. Or they're pointing the finger at the policymakers, saying it's not doing they're not doing their job. But the reality is this is a failing monetary system where the values aren't going up on fundamentals. There's no fundamentals here. This is something that I've been hammering home the point. It's not about fundamentals. It's about a system that is literally breaking at the seams, where you have really, this is, again, a debasement of the currency. You are not getting. Assets will continue to go up because you have an asset-based credit system. And this is what happens as you get to the end of these monetary systems. So again, now people ask, well, how does this all play out? The reality is nobody knows. You're going to have some sort of basically reset where basically these asset values eventually, collapse essentially underneath their own weight. And how that will play out, obviously, at the end of it is impossible to know. I mean, you could enter a scenario where the governments come in and rewrite the monetary system. There could be a new reserve currency. There's a multitude of outcomes, but nobody knows. And, again, we could be 2 years away from that. We could be 12 years away from that. But this is exactly what is happening. So these people that are crying to the MP, I feel bad for them because you can tell like they understand, and everybody here I think that's watching the show, everybody understands like something's not quite right. Everybody understands something's a little bit broken, but nobody can really put their finger on it. And so these individuals are just looking for people to blame. And I really do feel bad for them because at the end of the day, the average person is the person that is getting screwed. And again, this is something they talk about in the tales of the Mississippi bubble, where it was basically people that just started leveraging up assets. They became extremely rich. Again, at least on paper, they became extremely rich. And it wasn't even about the cash flows on the asset. It was about, they looked at repaying the debt basically through higher asset prices, right? So you just basically refinance that debt, pay down that burden and refinance again. And so that kind of went on until eventually it didn't. But I mean, I think that we look at Canada, for example, I mean, globally, obviously, but if we look at Canada here in particular, what have we seen during this pandemic? Okay, well, we've seen the monetary base expand close to 20% on an annualized basis. So imagine a scenario where all of a sudden you just add, 20% more loonies into the financial system in 1 year. You take the entire monetary base, you expand it by 20%. Naturally, that will probably get you less purchasing power. And so what you're seeing now is throughout this pandemic is you've seen residential mortgage credit growth expand to 10-year highs. So you've got a 10-year high in residential mortgage credit growth. But what you're actually seeing is consumer credit growth, which is, consumers just borrowing, for the sake of borrowing. So going to borrow money for a new couch or to finance a motor vehicle or whatever, that's actually collapsing. So that they're actually collapsing, but you're seeing this massive growth in mortgage credit growth. Again, people are leveraging up to buy assets. So you don't really have this productive economy anymore. You have this asset-based environment. And so to come sort of full circle for the people that are dumping on Adam Vaughan, again, I'm certainly not one of his supporters, but he wasn't wrong when he suggested, listen, like we can't really touch the values here of Canadian homeowners, because I think that he actually understands the system that has been created here is actually much larger than himself and is much larger than Canada. You really do have an environment where, what does the Fed do every time the stock market takes a dump? The Fed comes in and says, whoa, okay, let's walk back the talk about, tapering. Let's start cutting interest rates. We're going to ramp up QE again. And we saw that back in 2018 when this, the Fed went super hawkish. We're going to keep raising rates. We need to fix these broken markets. And what did they do? Whoa, the stock market came off. Interest rate cuts came in, QE came back on the table, and what happened? The asset markets went up and to the right. And so that's ultimately where we are today. So for those of you who are watching this and are frustrated. I understand the frustration, but the frustration is much larger than one person or one country. Unfortunately, we really are pretty much all screwed, but you start to look at it and say, okay, well, what is my alternative? So the alternative is you could sit in cash, which is, again, actively being devalued, where the federal government and the central bank are quite literally telling you, listen, we're going to debase this thing. Just look at, don't always have to look at their words, but you can look at their actions. So you have that option is one. You can stay in the currency which they're going to debase on you. Or number two, you have to play into the system, which it's kind of a broken system, and at the end of the day, again, could go on 2 years, could go on 12 years, could go on 14 years. But you don't have an alternative, because like what is a currency at the end of the day? It's just a piece of paper. It's just essentially a coupon or a credit that says this is worth something. It's just an exchange. It's basically an exchange of goods. It's like if you have this $20 bill, you can exchange it for something of quote unquote value. That's all it is. So the reality is you don't really have a choice. You can kind of sit there and disagree with the system, and you can also sit over here and play along with the system while still disagreeing with it. But anyways, I've rambled on for too long. I just wanted to make that insertion that I think people should follow the tales of the Mississippi bubble. I think that people, in these Facebook group chats and these Twitter threads about these affordable housing pundits, so many of them just not seeing the bigger picture. Like I really get the frustration. I'm empathetic to the frustration. I have family and friends who are priced out of these kind of markets. I agree that it needs to go through a reset, but the only way you go through that reset is not intentionally. It's going to be through some sort of crisis that we brought on that will basically force a reset of some sort. And I don't know, and nobody knows what that reset's going to look like. But we certainly know that, okay, asset markets such as housing going up, 30% on an annualized basis, eventually something will break. And the central banks, for example, will come in and will try to do patchwork. They might even try more QE again, and it probably won't work. Eventually, it'll get to a point where it just won't work. They'll own the entire market. So, anyways, that's all I got for this week. Hope you have a good weekend. It's supposed to be scorching hot here in Vancouver. We'll see you next week.